Ladies and gentlemen, good day and welcome to Arman Financial Services Limited Q3 FY22 earnings conference call hosted by Emkay Global Financial Services Limited. We have with us today Mr. Jayendra Patel, Vice Chairman and Managing Director, Mr. Alok Patel, Joint Managing Director, and Mr. Vivek Modi, Group CFO. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manjeet Nair from Emkay Global Financial Services. Thank you, and over to you, Mr. Nair.
Hi, this is Manjeet here. Good evening, everyone. I would like to welcome the management team of Arman Financial and thank them for this opportunity. I shall now hand over the call to the management for their opening remarks. Over to you, sir.
Thank you so much. This is Alok Patel here, and a very good evening to everyone. It's a pleasure to connect with all of you once again, and thanks for joining in. The purpose of this call is to discuss our financial performance for the third quarter and 9 months ended FY22, and to also attempt to answer any questions that you may have. We have issued a detailed press release and investor presentation as always for the quarter, and I hope you've had a chance to review it. I'll start with a brief overview of the industry and the business during the last quarter, and then we'll move to our financial performance. During the quarter, due to the newly evolved Omicron variant of COVID-19, there were very minor disruptions which were thankfully very limited and had a very small impact on our overall operations. Although the number of infections were high, the severity was much less and there was no major impact on the business and the cash flows of our borrowers. The government, RBI and other regulatory bodies are also fully supporting the banks and the NBFCs in all possible ways. These include unchanged interest rates, also includes RBI's accommodative stance in its decision to allow relaxation to the lenders until September 2022 to comply with the new regulations for upgrading the NPAs, which as you know was which stated that an NPA can only become standard once post clearing all of their dues. The budget announcements to increase infrastructure and other spending should also make sure that the positive growth momentum for the economy continues. So the overall picture today definitely looks positive, or at least much more positive than I imagined it to be a year and a half ago. Now I will give a brief overview on our financial performance for the fourth quarter, and post that we'll touch upon liquidity, disbursements and collections in more details. On the performance for the quarter, it gives me immense pleasure to inform all of you that our consolidated loan book as on 31st December 2021 crossed the 1,000 crore milestone, reaching rupees 1,045 crores. This was a milestone that was delayed for over a year due to the ongoing COVID crisis, but thanks to all the support received by our stakeholders, we have managed to cross this very important milestone. And with your continued support, we hope to cross many more milestones in the years to come. We registered a growth of 45% year on year, led by the addition of more than 35,000 new customers, with branches reaching optimal disbursement levels, along with the increase in average ticket size in the second cycle borrowers in the microfinance segment. Segmental AUM for microfinance stood at 856 crores, higher by 56% year over year. And the AUM for MSME stood at 139 crores, which is higher by almost 20%. And for the two-wheeler segment, our AUM stood at 49 crores, unfortunately down by 9% year over year. Consolidated loan disbursements during Q3 FY22 stood at 296 crores, up by 63% year over year. The total MSME and two-wheeler disbursements in Q3 were 38 crores and 16 crores respectively, while microfinance disbursements stood at 242 crores, higher by 64% year over year. This encouraging performance was mainly due to better penetration the addition of new customers combined with an improved macroeconomic environment. I would like to highlight that while we grow our disbursements, our core focus still lies on maintaining the quality of our assets and on enhancing profitability. Our repayment rate of the portfolio created post the first lockdown, that is portfolio created post September 2020, 18 months ago, is still hovering about 99% despite having the second and third waves in between. The gross total income during Q3 FY22 stood at 59 crores, up by 23% year over year. The net total income increased by 9% year over year to 33 crores. The profit after taxes increased by 140% year over year to 7 crores, aided by the lower provisioning requirements due to better asset quality of the loans dispersed COVID-19, as I mentioned earlier, since September 2020. Consolidated GNPA stood at 5% and NNPA stood at 1.1% for December 2021. The company has steadily created adequate provisions to take care of the unprecedented impact of the COVID pandemic, and I feel that the worst is definitely behind us in terms of NPA provisioning. Loan impairment costs for the quarter reduced to 6.6 crores. The company prudently created extra provisioning of 1.9 crores and took an aggressive write-off of 4.6 crores in this quarter. Cumulative loan provisioning stood at 64 crores as on 31st December 2021, covering 6.1% of the on-book AUM. Overall, provisioning reduced due to the better asset quality and aggressive write-offs aimed at reducing the NPA burden of pre-COVID doubtful assets. The company enjoys a healthy liquidity position with 126 crores in cash and in bank balance, liquid investments and undrawn CC limits. The consolidated debt to equity ratio stands at approximately 4.35x as on 31st December, and shareholders' equity stood at approximately 202 crores. We are pleased to inform that the company has closed a 100 crore direct assignment transaction with SBI in January, which represents the largest DA transaction in the company's history. The ALM continues to remain positive, and the company continues to have access to new sources of funds due to the company's robust balance sheet and prudent lending practices. Coming to the collections across segments continue to improve since the last 2 quarters, with overall collection efficiency of 94% in January 2022. Microfinance collections picked up with the repayment rates reaching 93% in January 22, despite the minor impact of the third wave. Two-wheeler and MSME collections continue to be well north of 95% during January 22. As mentioned earlier, post-COVID disbursement loan book collection efficiency stands at 99%. While the collection seems to be getting back on track, we anticipate that they should return to pre-COVID levels at the very most by Q1 of FY23 if there are no further disruptions due to the pandemic. Our branch expansion plan is going well on track, and we have opened 24 new branches during the month of December, January and February till date. Our total branch network is expected to reach around 280 to 290 branches by March 22. By expanding our branch network, we will improve our penetration capabilities in geographies that we are already present in, along with expanding our reach into the new geographies such as Bihar. Going by our asset-light business model, the capex required for each branch expansion is fairly minimal, allowing us to reach branch level break even quite quickly. The overall picture looks quite positive in terms of better collection efficiencies, eased liquidities, pickup in the credit demand across segments, better asset quality. Nevertheless, there is definitely some scope for improvement, which we'll be seeing in the coming few months and quarters. I strongly believe that our strong borrower base, our resilient business model, continuous customer engagement, growing reach, robust balance sheet, passionate on-ground workforce and experienced management team will ensure sustainable and profitable growth going forward without compromising on our asset quality. And And finally, to conclude, I would like to express my sincerest gratitude to all of our stakeholders for their continued support during these very difficult times, and a special note of appreciation for the company's field staff who continue to show perseverance during these difficult times that seems to keep on coming. I would like to request the operator now to open the floor for the question and answer session. Thank you very much.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Anish Goyal from Goyal Services. Please go ahead.
Good afternoon, everyone. Thanks for this wonderful opportunity. Sir, I have noticed that the percentage cost of funds has increased as compared to previous quarters. Can you please give the reason for same?
I'm sorry, I didn't understand. What has increased, you said?
Sir, percentage cost of funds has increased compared to the previous quarters.
Percentage cost of funds has increased from the last quarter.
Bilkul.
The weighted average cost of borrowing you are referring to?
Yeah.
No, that has overall declined, sir. I think what you might be noticing is timing differences of, uploading of, certain processing fees and things like that, of the increased borrowing that might get recognized right away. But overall, weighted average cost of borrowing is decreasing. But if you compare quarter to quarter, there might be some timing differences here and there, which is making it appear to increase.
Okay. Sir, microfinance yield is also falling. What are the reasons for the same?
Yes, you are right. You are right about that part. Microfinance yields are falling simply because of government regulations. So, two reasons actually. Number one, the interest rates have been falling in the market, and there is a cap of what interest rates that we can charge to our customers, which is and for the benefit of others, I'll just mention what that is. That is either 10% of our cost of borrowing, or 2.75x of the average base rate of the top 5 PSU banks. So that number, the latter number has been continuously falling for the last 5 or 6 quarters. And the second fact is that we have accepted a lot of CGS funds under the corporate guarantee scheme that was...
Pardon? Please repeat,
yes.
Sir.
We have taken money under the government CGS scheme, the corporate guarantee scheme.
Okay.
Which was extended to microfinance institutions, which provides basically a guarantee to banks in case of an MFI default. However, the caveat for accepting those funds is that it has to be done 2% lower than the lowest base rate by RBI. So, in our case, we'd have to do it in about 19.8%. So that's what you are seeing there. That's why the yields are declining along with, overall interest expense as well. So the margin remains somewhat consistent. However, that is, by the way, just kind of a little bit of a side note here. Overall, we are sort of anxiously awaiting the new RBI white paper to convert over into an actual regulation for the MFIs. And that will remove all kinds of margin caps. So there's fingers crossed that it comes out soon. And we can take advantage of that in not only in terms of increase in margins, but penetration into other areas of operations, and of course better competitive environment with the removal of regulatory arbitrage with other MFI players such as SFBs, a lot of other benefits as well.
Yeah, yes. Thanks for the detailed answer, sir. And any update on opening of new branches, as you have earlier told in Concall that December or January new branch openings will come?
Yeah, I think as I mentioned, we have opened up about 24 new branches, mostly in UP, Bihar, and Rajasthan. The plan is to another at least another 15 odd branches by the month end, and of course Bihar we have just very recently expanded into just about a month and a half ago. So now we are operating in how much is it? 8 states by now. 8 states, yeah.
Okay. And any sir updates on the equity infusion from QIP, because you have mentioned that after 1200 AUM you will be looking at QIP. So AUM are already close to 1050. So any update on that?
No. Unfortunately, no update on that. I think I'm waiting until this new RBI circular comes out. Hopefully provide a...
So by then you will be looking at the debt to raise funds?
Yeah. I mean, of course, debt raising is a continuous process for us. I think even right now we'll have at least 300-400 crores in the pipeline.
So, I mean, from a debt equity side, yes, the leverage has increased, if that is to be concerned. Yes, gone up to approximately 4.3 or something. But for us to, be absolutely comfortable on our CRAR and continue to further leverage. And then there are, as Alok just informed, that we've already done 100 crores of off-balance sheet transaction with SBI, wherein we've sold off a portfolio of 100 crores. So, while the equity market, might take some time, we're taking the corrective, whatever is required to be done to ensure that the debt continues to flow and there is no problem. Fueling, which comes branch expansion, is being well taken care of.
Okay. Thank you, sir. Thank you. Thank you very much.
Sure.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Savi Jain from 2.2 Capital Advisors. Please go ahead.
Yeah, hi Alok. So, this PPOP growth was, it was negative. So obviously, there are a few reasons for that. But if you could just again summarize what are the various reasons why, despite a 40+% AUM growth, we had a negative PPOP growth.
Pre-provisioning, you're talking of pre-provisioning profits?
Operating profit, yes.
So there's a combination of, as I mentioned to the gentleman earlier, the margins have been kind of falling down. So we are at about legally a 21.8% cap, which is, at least 3% lower than what it was about a year and a half ago or a year ago. On top of that, we are incurring a lot of operating cost for the branch expansions. Believe it or not, collecting money is also quite an expensive endeavor, as you can imagine, with all the COVID-related stuff going on. So yes, there's pressure on both sides, on the income side and on the expenses side as well. But I think what you will notice is, I'm not even sure if I can say this, but probably next quarter by Q4, all of those things would have been a little bit streamlined. And I think Q4 should be slightly better, at least in terms of, those both aspects about the income side and the expense side.
But you would still be operating at those yields because of the absence of that RBI notification, which still hasn't come.
Even if the RBI circular does come out tomorrow, there is not going to be any magic wand that will, unfortunately, all the assets which I have already created on my books are at the lower yield.
Correct.
So the weighted average will start to increase, of course, but that will still take some time or a few quarters, putting real impact on the P&L. Vivek, anything to add?
Yeah. So, on the pre-provisioning side, what also happens is, as the gentleman earlier was. So, it's not, there is to an extent there is a pressure on the NIM because of the lower yields that we have to do on MFI. But alongside, the funding within this quarter has in particular gone up, and the overall finance cost has gone up for that reason. And overall, as the portfolio growth continues, the yield and the revenues should start kind of going north.
Yeah.
So this, this RBI thing, will it be like again a draft paper or will it be a final notification?
No, it will be a final notification.
And it will be effective immediately?
I wish we could address that.
No, based on earlier circulars which have come for the industry, what do you anticipate?
I think it would not be immediately. I think if it comes today, it might be effective from 1st April or something like that.
Okay. Yeah, I mean, I think a lot of players were talking about this coming through in the last quarter, December quarter, and we are in February and it's still not come. So,
every industry gets glued to the budget for some or the other reason. I and Alok were glued to the budget speech for this one only.
Yes.
I think the government had more important things to take care of.
And not only that, I was watching the governor's, what was it called? Anyway, whatever it was. I thought, okay, वहाँ भी कुछ announce हो जाए तो.
Monetary policy meet. उसमें they don't discuss this. So, as speaking to the management of credit access, they are also obviously being the largest player, very anticipating this, and they said maybe after this policy meet is when they are finally going to discuss this. So let's see.
Again, this is pure speculation, but I believe that the go-ahead has been received by the governor, and now it's just awaiting some final touches, but that was about a month ago. So there's only so many touches that somebody can give to something. Let's see.
In terms of provisioning for the back book, is there something still left? You mentioned from FY23 maybe you will start. It will start normalizing. So do we expect another quarter of higher provisioning?
So the Arman book is completely provided for. In fact, more provided for than, so there were like write-backs and stuff also, as in written off assets were somewhat collected in the last quarter. In the micro side, I mean, I think, as I said, the worst is definitely behind us. There might be some minor level of provisioning which comes in. And, as the portfolio keeps growing, anyway, you have to provide for 1% of standard assets. So it's not like the provisions will stop, but the COVID provisions have slowed down quite a bit, and I think they'll continue to slow down as it keeps going. But yeah, I think I was mentioning as far as the repayment rate, we are expecting the repayment rate to normalize by Q1 of FY23. So coming up in another 4.5 odd months. Unless something drastic happens, and I keep jinxing it by saying that, but something or other always comes up. But let's hope. I mean, after the third wave, there was a little bit of a very negligible impact of customers and staff members that were sick for 3-4 days. So the collection might have come in a little late or something, but nothing crazy happened. I think people are used to it by now. My staff and members and all of us are just kind of used to these minor COVID-related disruptions, and they take it in stride. So I think after a year and a half of this, or almost 2 years of this, you can get used to anything, and I guess we are used to it by now.
And this daily stamping of NPA, that notification did not have an impact on our on the financials this quarter?
No, sorry. One, generally what happens is, since we are in the largely our loans are unsecured loans, if a customer manages or flows down into the third or the fourth bucket and becomes an NPA, even historically we've seen that 9 in 10 cases never comes back to a pre-NPA or less than 90 days DPD. They continue to be in more than 90 DPD because they might come back and pay us one installment regularly, but that doesn't make them move anywhere into the 60 DPD bucket. So the overall impact, because of the kind of profile of the customer, is not really very very impactful. But still, it in the longer run, we feel that it could have an impact, at least to the extent of increasing the NPAs in a standard, stable kind of a condition by about 0.5%.
The other thing also is that, see, as far as we are concerned, the largest chunk of NPAs are in the old pre-COVID assets, right? So those who are already well over the 90 plus DPDs, or the newer assets which were created, as you heard me, I mean, we have not been facing too many issues. So the overall impact anyway is not going to be very, very large. And now there is a new, I think they have delayed it until September, the implementation of it. But yeah, as Vivek said, maybe about 40 bips, 50 bips at the very most.
Okay. Just a couple of more questions. So one is, are we still doing group meetings, or we now moved to stop giving JLG loans and doing more of individual loans? What is it?
We are still doing JLG. We are doing individual loans as well. I believe that we have done in the MSME side, we are doing about 15 to 16 crores. In the micro side, we are doing about 4-5 crores. So almost 20 crores of disbursements we are doing in the individual lending business in a month. But rest of them is JLG.
So yeah, the JLG is becoming a smaller proportion of the overall book, is it?
No way. I mean, what probably Alok is trying to say is that MSME is anyway an individual lending book. In microfinance, as during the last call, we kind of said that we've already started looking at a pilot model of individual lending book. There, we're seeing about 3-4 crores of disbursements
on a monthly
basis.
Yeah.
But are we doing grouping? Is it, in this kind of...
Yeah. So
Absolutely. We are doing group meetings. We are doing the whole JLG thing. Yes. It's not it's not completely out of fashion or anything.
No, it still continues to bread, butter and cheese, everything.
Yeah, bread, butter, cheese, jam, whatever you want to call it. There is
microfinance will continue that.
When I say that the individual loan is the future, what I typically mean is I'm talking about 5 years down the road. Today's scenario, JLG is still the king.
Right.
In terms of what,
Right. And lastly, Maharashtra, are we still lending there, or is it going to become a smaller part of the book?
The book is shrinking. We are still lending in the branches which are not that badly impacted. Other branches we are not. Overall, it's declining. But yes, we are dispersing in Maharashtra. Not as much as it was pre-COVID, but we are.
So these new states, for example, Bihar is kind of it's likely maybe a riskier state based on experience of some other players. So are you, obviously diversification is good, and we are already quite diversified now with 5 states being a large part of the book. So is it really necessary, to get into some of these other states which might not, which might be slightly, riskier and obviously costlier also because operating expenses will be higher?
No, I've been considering opening in Bihar for at least 3-4 years, 5 years. The outside perception is risky, but I think if you look at the data, the hard data, the numbers from both Demon and COVID, it would appear that Bihar is one of the best states to operate in India. So that's what really allowed me to pull the trigger on a small way to say, okay, well, let's open in. Now there are, of course, a fair share of issues, law and order issues and whatnot, which are there in Bihar. But as far as the quality of the customers go, at least on the numbers, I mean, it's much better than even Gujarat, or it's much better than even in Madhya Pradesh or any other place. It's a little bit crowded there. It seems that I'm not the only one who can read numbers, so there are a lot of other players also moving in. So we'll have to do it carefully. We are we are expanding from the border regions of UP to our existing branch network in UP, and that is what we typically do. But I think, it's, as microfinance matures, either you make headways into new places or you'll be left behind.
Couldn't we tackle that by getting into newer products rather than newer geographies? So
We are doing both. We are trying to get into newer products and newer.
But in terms of new products, two-wheelers, maybe you did a tweak with that rural. Otherwise, for the last few years, I think we've not really piloted a new product per se, maybe something like, say, a micro housing or something, which...
It's not the right time. It's not the right time to get into new things.
Mm-hmm.
I understand what you're trying to say, and of course...
just to draw a parallel, for example, we had these two small finance banks, Ujjivan and Equitas. One went to that entire geographical diversification, and one went to the entire product diversification. And, in hindsight, Equitas seem to have done a much better job as compared to, say, Ujjivan. So just, keeping that playbook in mind, I was just asking whether it is better to also look at more products rather than more geographies.
In my experience, I think you need a little bit of both. But as far as, doing product diversification, which is related to what you know already, that is safer to do at a time like this because, like all companies and all people, you have limited resources. And my management force and everybody is busy, kind of trying to take care of COVID-related issues at this point, right? And with so much kind of unexpected stuff into the future, I don't want to get into something which I don't know exactly how to do. During good times, when you have a lot of profit and things are on auto mode, you have a lot of time to concentrate on newer things. Right now is not the right time, according to me, to get into something completely new. Individual loans, all of those things, they're distant cousins of what I'm already doing. So that's not really that big of a deal. But this is a whole another, affordable housing is a whole another, completely a different segment.
Got it. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Balakrishna from Asman Investments. Please go ahead.
Good evening, sir. Many congratulations for crossing 1,000 crore AUM.
Thank you.
So I have a couple of questions. As an industry in MFI, if I consider the period of pre-COVID and the post-COVID period that is going to be afterward, from, let's say, from 2022. So do you see any fundamental changes in the NPA trend that were in pre-COVID period and from the period or 2022 onwards? Is there any fundamental shift in the industry because the average is going to be higher than pre-COVID?
So if I understand your question correctly, what you are asking is, compared to pre-COVID and post-COVID. So let's forget about COVID-related losses, but as the regular operations resume, will the NPAs on a steady state be higher or lower or same than what they were pre-COVID? Is that your question?
Exactly.
They will be higher, very frankly speaking. Not by a very large amount, but they'll be slightly higher as the ticket sizes continue to increase and as microfinance continues to penetrate deeper and deeper. The lower hanging fruits kind of go away and you are taking slightly higher risk on other customers. And I think people are getting used to credit. They have a lot of different areas to get credit from. So as competition increases, it's natural that the NPAs will probably increase slightly as well. But I mean, I've said this often that, we were in a golden age for like a good 7-8 years in MFI where loan losses were less than 1%. I mean, those, unless you are doing gold loan or something like that, it's unheard of, right? Even in the secured business, even in two-wheeler, it was never the case. So as an industry, rather than probably lying to ourselves that things have been good in the past and they'll continue to be good in the future, it's better to be mentally prepared for something a little worse than it was in the past. But if it's the same or slightly less, nobody will be happier than I will be.
Okay. And my second question, do we do any kind of or any percentage of loan that we disburse in cash?
No, we are 100% cashless in all segments.
And almost 4 years now.
Yeah, almost for 4 years.
The single rupee of cash that goes out has gone out last 4 years now.
Okay. And it is also mentioned in the investor presentation that the collection efficiency of loan book of a post-COVID loan book is around 99%. Okay. So when I look at the disbursement of last 5 quarters, so it is around 1140 crore, and total loans outstanding on your balance sheet is around 965 crores. So I'm not able to understand the math here, because you say your overall collection efficiency is between 92 to 95%, and your post-COVID loan book collection efficiency is 99%.
Yeah, correct. So what? Yeah, please.
Go ahead.
No. No, I mean, that's just the way the math works out. It's just that whatever is left now, that is pre-COVID, right? I mean, that has a much lower collection efficiency, because the stuff that was good has already been paid off to an extent. And that 1100 crore that you mentioned, I'm sure it's correct. I don't know what the disbursement has been in the last 5 quarters. But that also gets repaid, right? So you can't really compare that since inception, I have disbursed maybe 5,000 crores, but that doesn't mean by even the good portfolio continues to repay. So that will bring down their overall weightage in the repayment calculation.
So basically what you are saying is that a good portion of 1140 crore, okay? So basically, and so you are saying that a lot of loans that you disbursed after September 2020 got repaid before the loan you disbursed pre-September 2020, right? So is that a very big, so...
No, imagine if I lend you 100 rupees today, right? And you pay me as of 2 rupees tomorrow. Your outstanding will become 98, right?
Yes.
Now, that same 100 rupees, if I gave it to you 2 years ago, your outstanding might be, let's say, 15 rupees. And you pay me 2 rupees, that will become 13. So the overall portfolio weightages will be different than the repayment weightages, because both EMIs are 2 rupees, right? But the portfolio is very different. One is 98 rupees, the other will be 13 rupees.
Yeah. So basically there might be a couple of scenarios, right? So wherein the loans you disbursed post COVID are of shorter period, and the earlier loans would be for the longer period, and the second scenario you mentioned would be something of that sort.
look at this way.
That is absolutely not what we are saying.
1100 crores. The outstanding of the 1100 crores, let's say, out of that 10,045 crores of total AUM, would stand at approximately 70% of the AUM. So out of 1100 crores, about 40% would have run off in a regular course of, something which has been disbursed
1.5 years ago.
1.5 years ago in September, would have, repaid about 15 installments already.
And something which was disbursed in February and March of 2020 with the moratorium, it would be almost close to being run off. But still there'll be like a few months left on it. But the EMIs will be the same. Anyway, we'll probably let us move to your next question. Maybe you can call Vivek for the mathematical understanding of this.
Yeah. All right. And so basically, can you tell me out? So on your consolidated balance sheet, there is a loan book. Loan of around 965 crores. So what would be the percentage of pre-COVID and post-COVID loan book in this 965?
What is it, Vivek? About 25% or something would be pre-COVID. About 75% would be post-COVID. Roughly speaking, we can probably give you a better answer.
But about 75% is post-COVID. The pre-COVID is less than half.
But the repayment would be probably higher than that. Because again, this is so math.
Again, a case in point would be like, say for example, NPA cases. Out of my 3.8% of NPA, there would be hardly a case which is a post-COVID disbursement. The entire NPA would be pre-COVID.
Right. Correct.
So where even collections, a demand is there, the collections are not happening. The collections are much
not
less, or are less than, let's say, 30%.
Right.
Okay. That's all from my side. Thank you so much.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of V. Srinath from Bellwether Capital. Please go ahead.
Hi, Alok. You guys can hear me?
Yeah. Right.
Yeah. Can you just take me through plans for MSME? What are the growth outlook? Disbursements have somewhat kind of come back to pre-COVID. So where are we standing? And then there was a particular line in the presentation that said that you have tightened cash flow requirements and COVID impact layer. Can you kind of explain that too? And again, given that we are coming out, and if there are customers who have clear credit screens in the last 2 years and who have not defaulted, wouldn't it be better at least leave the norms as is? Because you would already have kind of clean data coming from the bureaus. So yeah, just wanted to understand broadly, how are you seeing MSME over a 12 to 18 month kind of time horizon?
No, we love MSME. It's a great business to be in. The returns are great. The losses, if you compare it with microfinance, are probably same or less. As I said, Arman, we are already out and we are at a situation that we are writing back. So it's a great business. But it takes a very specific kind of customer to find that customer, and of course the kind of volumes and the volume gains that you can expect from the microfinance side, it's at least post-COVID, it's been difficult to keep that up because it takes you and your team to find that specific kind of customer who can, afford the rates, and you can evaluate their cash flows. And so the rejection rates continue to be high. But that being said, we are, I think the disbursement levels are increasing. We are, continuing opening branches in that segment as well. So a plan of opening about 10-12 branches. We have already opened about 3 branches in the last couple of months.
Geographically, we've gone to Rajasthan.
To Rajasthan as well. So geographically, we have expanded into Rajasthan at areas we found to be good for doing this kind of a business. So overall, I'm quite bullish on it, but it's going to take its own time. COVID did have a setback. I mean, we tightened the underwriting norms, and it was very difficult to evaluate the cash flows. So it takes a very specific, as I said, it takes a very specific set of circumstances to disperse the loan to the MSME customer. But we are working on it. But otherwise, I love the business. There's absolutely nothing wrong with the business. What was your second question on what?
Do you expect a ramp up there also in disbursements to start?
Yeah,
probably in a quarter or two, similar to MFI, we have now crossed. Looks like we are firmly on a growth path there. Do you expect MSME also to kind of hit a growth path in a quarter or two? How are you seeing it?
Absolutely. All our efforts are going towards that only. So, if we didn't go to that path, then clearly, we have not succeeded, but our efforts are going towards that path, as you say.
Perfect. One final housekeeping question on MSME is, for MSME book also, the loans given post April, are they 99% collection efficiency similar to MFI? Is that trend similar?
No, yeah, absolutely. It is 99% plus collections, yes.
Okay. And the last one is this, we've seen two-wheeler kind of ramp up from 7 crore to 16 crore disbursement. Is this ramp up coming from rural two-wheeler or the erstwhile business that we had that, we were looking to kind of ramp down?
No, that's a cyclical kind of a benefit because October, November of this quarter are supposed to be the best month for two-wheeler sales.
Diwali season.
Got it. So both
what would be the rural two-wheeler contribution in that 16 crore?
What was the contribution? I think maybe about 5
roughly. Yeah.
In the rural. About 6 crores would be in the rural and 10 crores in the urban.
Got it. So that is scaling up at a slow pace, but it's scaling up.
Yeah, in terms of percentages, actually in terms of disbursement, especially in this festive season, it would have been upwards of 25% of the overall two-wheeler sales, which kind of is now reflecting on the overall, growth of the portfolio itself. But again, as I said, to a large extent, quarter 2 to quarter 3 growth is so much about the festive season also in the two-wheeler segment.
Great. Thanks, guys. Thanks a lot. I'll get back into the question team.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from Sachin Motwani from Param Capital Research. Please go ahead.
Yeah. Hi, Alok. My first question is on the MFI business. In your presentation, you mentioned 35,000 average ticket size, but you have been hovering around 23,000 for many years now. I think you were at 21,000 average ticket size, which is now 23,000 something. So this and the other area of AUM per branch, we've been at around 4 crores 4 crores AUM per branch for quite some time now. So why are we not able to scale these numbers up? Just wanted to get your thoughts on that. That was my first question.
On the average ticket sizes, I think pre-COVID we were at probably around 28 or 26,000 if I'm not mistaken.
On the disbursement side, yeah,
28,000 or so.
Which has gone up to 35.
Which has gone up to 35, and there are no better excuse than to say that that's where the trend of the market is going. In the microfinance segment, you don't really compete too much on the interest rates and things of that sort. What you are competing a lot on is on ticket size and turnaround time and things of that sort. So the trend towards the market is going towards increasing ticket sizes.
Okay.
To give you a little bit of more comfort around that, you see the higher ticket sizes are only in the future cycles. That largely speaking is on the second cycle, third cycle, and so on and so forth.
Right.
Now, when we are lending money, I would say at least 15% of the microfinance customers for now have been kind of taken away from the market. Mm-hmm. Because we are not lending money to anybody who has defaulted during COVID, right? So even if they didn't pay for 4-5 months during COVID and now are doing okay, we are still erring on the side of caution and saying that, okay, we will not lend money to them. But the customers who are left are like the cream customers, right? Even for us. So these are customers who have continued to pay us without any kind of difficulty or any problems during COVID, during first, second, third wave, whatever it may be. So am I comfortable taking a slightly higher risk on them? Yes, maybe. I mean, I think it would be fair to say yes. So you're left, I mean, a lot of these customers which we are giving higher ticket amounts to have been through like the worst test that you can imagine, right? COVID. So, and they proved themselves. So I think it should be okay. As far as the branches go, listen here, I think overall the branches AUMs continue to increase, but we have a policy that splits a branch once it approaches a certain AUM. So once it crosses 5-6 crore ka AUM, we split that branch into a new branch because that's part of our risk mitigation side. So you'll see that as a new branch, but our policy will not allow an average branch to be more than a certain AUM.
Understood. And how is the competitive intensity? Because when you mentioned that 15% of MFI customers are now touching and the 85 are cream customers. So is the competitive intensity relatively lesser benign, especially post COVID now or during COVID times?
No, it's honestly as competitive. I mean, it kind of ebbs and flows in that sense. Like during the waves and stuff, nobody's lending anything, and then everybody remembers that, oh, we have targets, and everybody starts dispersing left and right. So it's kind of all over the place if you look at it throughout the year. But let's say today, like for example, February or January, I mean, the competition is just as high as it was pre-COVID. I don't see any relief from that. And that is fine. Competition is okay. We can manage competition.
But for you see it more from the SFB side or MFIs or the universal banks?
It is more from the MFI side. I mean, probably this might be a better question to ask my Chief Operating Officer. But based on my knowledge, it is not so much on the SFB side because SFBs are facing their own issues, at least in the areas that we operate in. I could be wrong on this, but the MFIs are also, there's a lot of funds available, let me tell you that much also. So people are not facing so much of a liquidity issue, it seems to me. Again, I don't have numbers to back this, but based on different, the CGS schemes, as I mentioned, and other schemes that the government's been running, and the overall availability of liquidity in the market, along with PSL guidelines and things like that, the MFIs have, the good MFIs or at least the decent MFIs have a good supply of money flowing in. So that has not been an issue.
Okay, got it. Next question I have was on this direct assignment with SBI. So you would be, what would be your broader terms? You would be earning a 10% spread. Your margins would be similar as the current business?
So how DA works is we take the assets that we own and sell it. So there are no margins to worry about.
Yeah.
But the deal we did was somewhere around 10%. I mean, it's kind of a complex thing, right? But all-in cost would be somewhere around 11% for us after considering the processing fee and the other requirements, the stamp duties and things of that sort. The published rate would be somewhere around 10%.
Generally a DA could work in favor of increasing the NII, and kind of that addresses the...
Yeah, so there is no margin requirement on DA, which is what I always said through the years, that if it allows you to get a little bit better margin, then I'm all for doing off-book transactions. And this was such an example.
Got it. Just one correction on your slide actually. On your slide number 13, your reported cost to income is 28%, which I think you've taken the cost to income as a percentage from a total gross income instead of the NII plus other income.
That's absolutely possible. Thank you so much, team.
No issues. Congrats and all the best for future quarters.
Thank you so much.
Thank you. The next question is from the name of Rupesh Titya from Intelsense Capital. Please go ahead.
Hello, sir. Can you hear me?
Yes.
Okay. So my first question, Alok, is you are at 300 crore roughly disbursement in Q3. In quarter 4 of next financial year, are we all set to reach, let's say, 500 crore kind of disbursement quarterly run rate?
500 crores a quarter.
In quarter 4 of 23.
That seems a little bit out there, but let us say somewhere in the neighborhood of about 450 crores should be doable. Might be touching 100. I don't want to over-promise anything. 450 kind of per quarter seems quite doable by Q4 of next year.
Yes, 12 months down the line, yes.
Disclaimer always is, let us see what further disruptions are coming due to COVID.
Okay. And then my second question in terms of business design, so to say, the cost of funds. And you have always maintained that MFI is not a cost of funds business. It's more of a distribution business, and your edge lies in finding first-time borrowers or rural borrowers and kind of areas where competition will take some time to come in. That is kind of your edge that whatever I have observed your business for so many years now. So, but you are also saying that two things are happening, right? The penetration is going to increase with this RBI circular. Also, the penetration is going to increase, and the ticket sizes are on an increasing trend. These are the two, trends in the industry. So, how long do you see that the cost of funds won't matter to you? Like, are you okay for, let's say, next 5 years that cost of funds won't become bottleneck in terms of, business design?
The cost of mattering as soon as this new RBI circular comes out. Because once you remove the margin caps, then the idea is, today, whatever cost savings I get from my borrowing cost, I have to pass it on, by law, to my customers, right? At least on a weighted average. So once that is removed, I have to worry about 3 things instead of 2 things, right? I have to worry about my top line, I have to worry about my interest cost, and I have to worry about my operating costs. So all 3 of those things will matter to the bottom line. And it will be a balance of those 3 which will... So we are in a place right now where it's going to start mattering very soon, and hopefully sooner rather than later.
But that is still about 10% cap, right? That probably everybody is looking at as an increased bottom line and more distribution. I think the industry players like you are looking at that margin cap removal in this way.
No, the margin cap will get removed. So if I'm able to save 1% on my borrowing cost, or if I'm able to charge 1% more to my customer, then that will directly impact my bottom line, right? That.
So that way you're looking. But my question is, our cost of funds disadvantage over, let's say, SFBs or someone like Bandhan Bank is really huge, right? And we have been, kind of smart to pick these rural pockets and stay in those rural pockets and get kind of yields that we get, right? But how long that can continue?
Sir, let me couple of things. So my cost of borrowing disadvantage, so to speak, is far from huge now. It used to be quite huge. Today, I'm at a place and at a scale where I'm able to attract funds at a lower cost. So our rating has also, we are at A minus at this point as well. So while there is a little bit of a disadvantage, I'm not going to deny that, but I have other advantages that SFBs don't, like my operating cost structure, In fact, a lot of them are not making very much money with their scale, or a lot of them are making losses. I have not made a loss in any quarter. So let us put aside the differences between an NBFC MFI structure and an SFB structure, because I've always said that these are they are apples and oranges. They might be fruits, but they are different kinds of fruits. As far as the other MFIs go, I mean, there are few MFIs that have a distinct advantage over me, maybe Credit Access or somebody like that. But there are companies which are much, much larger than me, and I have managed borrowing at a lower cost. So it's not just as a function of scale. I think your vintage matters, your rating matters, your overall, profitability, your governance, and a lot of other factors play into what rate that you borrow from. But yeah, I don't disagree with you that our core competency has always gone out to find the new customers and get into the niche areas where there is not a lot of competition, and we can service these customers in a way. Slowly that might be going away, not by choice, but because the market is expanding and there are a lot of players, and players are expanding and everybody's opening new branches. So that is the reality of competition. I think we've done a good job with the places we were good at, and I think we'll continue to do a good job, hopefully, as the market environment keeps changing.
Okay. And I'm sorry to harp on this, but how about ticket size? I mean, do you, let's say, if you want to lend a really good customer at 50,000-60,000, does your business decision kind of prevent it because of your cost of funds? I mean, how does cost of funds impact your ticket size, in terms of a good customer or in terms of risk to portfolio?
Cost of borrowing is not going to really impact my ticket sizes. Cost of borrowing has two advantages. One is it increases your portfolio faster and thereby your potential interest income that you can earn. And the second thing is that it reduces your overall cost or operating cost as a percentage of your portfolio. But it comes with the risk that, if you're giving a lot of money to somebody who can't afford it, your loan losses might increase to that aspect. So this is a continuous balance that needs to take place. Me personally, I don't like large ticket sizes. If my hand is forced due to competition and stuff like that, of course I have to run a business and I have to consider practical applications. But in the long term, there are players right now, which I'll not name, that are doing 75,000 rupees microfinance JLG loans, second cycle loans, and 60,000 first cycle loans. I mean, that's absolutely ridiculous. I would not do that at all. I mean, if you want to do 60,000, 75,000, do an individual model, go down to their cash flows, try to understand their business, try to understand what they're doing, and lend them $1.5 lakh if they deserve it. There's no problem. But if you're trying to give a larger ticket size under the facade of joint liability, which is getting diluted day by day as we speak, then I think fundamentally there's something wrong with that business model. Now, I'll be happily proven wrong. Maybe their asset size will be completely okay, and 2, 3 years, 4 years down the road, there'll be somebody that tells me that, you should have done the same thing. Look at that guy across the street. He made a buttload of money doing that, which is fine. I'll have to make my peace with it if that happens. But today, I think I have to go by my instincts, which to say that you cannot do such a large ticket size under the JLG model. You'll have to do it under a MSME or an individual loan model where you are actually going down and trying to do a little bit more underwriting.
Okay. And then my last question, is there any balance transfer out kind of data in MFI or in MSME? I mean, it may be balance transfer out is probably not the right term, but you understand, right? I mean, if customers going to a different borrower, you do better service, better rate, whatever, better repayment terms.
No, so you are saying that somebody getting refinancing from somebody else, and if they come with a check of another finance company and somebody takes over, that doesn't happen in microfinance. that might happen unofficially where they borrow money from somebody and prepay my money. Prepayments do happen all the time. But no, I mean, I don't have a single instance to share where somebody has bought over debt. And because, I mean, that doesn't make sense in unsecured, right? Bandhan was trying to do it years ago, and I think I said it, how do you do that in an unsecured? Because what's stopping him from borrowing someplace else, right?
So, I mean, we might see prepayments happening for obvious reasons, that somebody might be getting a LAP or a housing loan and wants to repay the
higher interest.
Or just because the housing company might have said that your EMI servicing is very high and you will not be able to get a higher loan, when you repay this.
Right.
So that kind of thing leads to about prepayments every now and then.
I mean, it wouldn't be very large. Maybe
it's not very large.
Even if that. But that does tend to happen. But that trend has not started yet, where people are like officially refinancing and they get a demand draft of some finance company to close their loans out.
Okay. Thank you. Thank you so much, sir, for answering my question.
Sure.
Thank you. The next question is from Savi Jain from 2.2 Capital Advisors. Please go ahead.
Yeah, hi. So I was just looking at slide number 18, which talks about your liabilities. So I was just struggling to understand, some parts of the pie chart. So there is, a 2% direct assignment, a 1% direct assignment in the pie chart. Am I right? What you mentioned as DA?
Yeah. So if you are talking about the SBI DA transaction, that is in January. So
No. That I understand. What I'm asking is that, you have separately written in the left chart that there is a 581 million direct assignment, whereas in the graph it is only 2%.
Sorry? 581 million and 72 million, 7.2 crore. So there is a note in the bottom, I believe. Okay. Is there some typo? Is that what you're saying, Savi?
No, I'm not able to understand. If it is 581 million, then it is actually much higher than 2%, which is shown in the chart. So,
58 million. Yeah, that's possible. Let us look into that.
I mean, I'm not too sure. I'm going a bit colorblind as well on this one. Because
No, it is that only because after green there is DA, which is purple.
Yeah,
so
if it was 58 divided by 766, he's saying it should be 7.5% and not 2%. FY21 he's talking about on the left side.
Similarly on the FY20, similarly on the right one also, which shows 1%. That is still quite close, not that different, but yeah, that could be still correct. But anyway, my question is that so what you're saying is, so you remember offhand that your direct assignment was like very small earlier. It was to the tune of some 5-10 crores.
We do a lot of PTCs, but after Ind AS, direct assignment definition has changed to completely without recourse. So while pre-Ind AS something was off balance sheet, we had to re-recognize back on the balance sheet if it had recourse. Vivek, correct me if I'm wrong, if I'm getting the accounting terms right. So if you try to compare, let's say, pre-Ind AS and post-Ind AS, it will be a little hard to compare. But we haven't done a lot of DA transactions. The SBI one which we just did has been the largest. A lot of the DAs have run off also because the max DAs that we can do is maybe about 19 or 20 months because they require, I think, a 3-month vintage and then another month or so for the rating and everything to be, the pool to be rated and everything like that. So the average tenure will be left will be 17, 18 months. So since COVID, we have not done a lot of DA transactions.
We've not done.
We've done any
DA. The SBI is the first after that.
Yeah. So this one seems right to me. It will be about 0.8%.
No. Let me correct. I mean, to everybody hearing this, I think the footnote is incorrect. That probably is not got.
The footnote is incorrect.
The total DA outstanding would have been about 12.5 crores at the beginning of the financial year at March 21, which was kind of close to 1% rounded off.
Yeah, 2% or so.
2%
rounded.
So this is all of this credit risk is assumed by the bank. You have no credit enhancements that you have provided to the bank.
No. DA structure as per the RBI policy does not allow any credit enhancement.
So, but do you need to keep capital on this?
No, there's no cash collateral if that's what you mean.
So this goes out of your book, right?
Yeah, that's what exactly.
And is it like a profitable? Given that now you have these limitations on spreads, does it make sense to do it at 10%? Do you make money ROE on this a transaction?
It makes absolute sense to do it. The only problem is that the profit you have to recognize on it right away. So your profit for that quarter might appear to be inflated. Well, not inflated, that's the wrong term. But while the operating expenses of servicing this loan might
be over a period of two financial years.
2 financial years, the profit from the same has to be recognized right away.
So basically next quarter there will be a abnormal jump in profitability because of this transaction.
We're discussing only accounting side of it at this point of time, not that we want to kind of say anything regarding the.
No. That I understand. I'm saying we need to, take it as an extraordinary income when it appears in the right thing to do would be to amortize it over the period of the loan.
I agree with you. In fact, amortization is, but IndiaS is quite weird.
Savi, what happens is we'll have to go by what the accounting standards and.
Correct. So the same is not true for securitization and so where does PTC appear in this?
So DA is securitization, which is a true sale. PTC will appear on balance sheet in this.
PTC is actually by IndiaS standards not off balance sheet, and in that case you amortize the overall cost and the.
So in this graph, where does it appear?
So in this graph, it would be bundled up in the bank or the FI, wherever there is securitization. No? So there is 7% securitization, no? The blue one.
The blue one will have
it's a PTC.
PTC and securitization are one and the same thing?
Maybe for nomenclature, let's understand in our presentation, the securitization here means the PTC, and the DA is a direct assignment, which is a true sale and does not have any recourse to the investor, hence off balance sheet.
Would they also include the PLIs also?
No, PLI is not.
So securitization, what is the credit enhancement that you provide to the lender?
That depends on contract to contract.
Sorry, that will be too specific to address at this level. But largely speaking, there would be second loss credit enhancement that would happen through subordination, and there could be cash collateral, and there is over collateralization as well. So generally the recourse kind of thing available to the investors could be anywhere between 12% to 25%, depending on the overall structuring.
Oh, that's quite a lot actually. So basically, they don't really ever see any NPA on that, and because your NPA would be your credit losses would be less than whatever 6-7% even in the worst case scenario. So
only in the cases where the company completely flat out defaults.
Correct.
Only in that case.
Yeah.
But normal asset losses on an ongoing basis, typically they would not see any losses.
So there the cost would be lower?
Higher.
The coupons are generally lower, but the overall cost will go up because you will have a cash collateral, you will have a subordination that might happen through a second loss guarantee coming in, and the overall legal opinion. The initial setup cost generally is high. So
plus on the bank's books, a PTC is a treasury instrument. A DA transaction goes directly into their balance sheet as a retail loan or whatever it may be. So there are a lot of differences. It took us a while to also get used to these instruments, and every instrument has first, second, third loss kind of framework. Some of them come with guarantees. I'm talking about the PTC specifically, and so the cost the overall coupon to the bank might be lower, but the
cost of funds for us will go up.
Will go up because there'll be a negative carry might be on the cash collateral. There'll be a guarantee fee maybe that you have to provide for the secondary losses. So stuff like that.
Thank you very much. So the line for the participant dropped. Ladies and gentlemen, that was the last question for today. On behalf of Emkay Global Financial Service, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.
Thank you so much. Thank you.